Welcome, Vistage members and guests. I'm Dave Nelson, a 13-year Vistage member out of the Pittsburgh area, part of CE 676, and your Fridays with Vistage host. Today we're discussing working capital, financing your growing company, and our expert guest is Ami Kassar. Ami, welcome to Fridays with Vistage.
Thanks, Dave. Pleasure to be with all of you.
So quick introduction, and you can see a little bit about Ami on the screen, and thank you for including a photo. Ami is the CEO and founder of MultiFunding, LLC, and he's also a Vistage member. He's a nationally renowned expert on access to capital for entrepreneurs, so perfect for today. He's committed to ensuring that business owners have the best possible access to the capital structures to help grow and manage their businesses. Kassar is regularly featured in the national press and writes a regular column for Inc.com. He's advised the White House, the Federal Reserve Bank, and the Treasury Department on the business credit markets. In addition, Kassar is a regular speaker at universities and business events across the country, and of course, Vistage groups across the country. So if you like what you hear today, ask your chair to get Ami scheduled in. And it's always about entrepreneurship and access to capital. And today we're going to take questions as we go. So I encourage you to type your questions along the way right in the WebEx Q&A panel. So with that, Ami, let's get started.
David, thank you, and thank you very much for everyone for joining us today. What we do at MultiFunding, which I think gives us a unique and interesting vantage point about the different loan solutions, is we're like a big loan matchmaker. We listen to the stories of CEOs and entrepreneurs across the country, and we work with them collaboratively to figure out where they fit into the debt markets, what debt products or structures work the best for them, and then we help place them with the very best solutions. So we have heard thousands of stories over the years in every shape and size, and we hope that this vantage point helps us to help all of you today. That being said, I'm going to ask a favor. I don't know if any of you have ever given a webinar, but sometimes when you're looking at your computer screen and you can't look in the eyes of the audience, it's very difficult to know what people are thinking or how they're responding or what they're looking at. So if everyone would be so kind to just take 30 seconds or so and write down or just jot in the Q&A panel if there's one particular thing they want to get out of today, or if they have any questions in particular, specific questions they want answered, jot them down, and then Dave will be happy to interject them as we go along and try to get to as many of them as possible. Our goal here is to help you to get the information that you're looking for. So
and also for folks who might not be very familiar with the WebEx control panel, you'll see in probably the lower right area of your screen, it says Q&A. If the little triangle is pointing sideways, click it so it's pointing downwards, and then you'll actually have an open panel. You can type your question at the bottom. So please let us know what you'd like to hear out of the webinar and specific questions now or as we go.
Great. So feel free to plug those in, again, now or as we go, and we'll keep going. But we want to make sure that you get what you're looking for in today's webinar.
Hey, since somebody did type a quick question in, let's just jump right on it, because Andrew's asked, are banks scared to lend right now? Our business is having trouble finding banks that want to take risks without the backing of the SBA. And, I've been hearing in the news myself about, they seem to be increasing their capital reserves. So what's the big picture there?
So we feel that banks are starting to tighten up again, and that lenders are starting to tighten up again, and we've seen it over the last few months, and loans that we could have gotten done with a bank maybe 6 months or a year ago, they seem to be tightening up. That being said, banks are in the business of lending money, and if borrowers have incredible collateral, credit, cash flow, they're going to still make you the loan. So it's about finding the right bank, and if you're not bankable, making sure that you use the SBA to your best advantage, and if you can't use the SBA, making sure that if you step into the world of alternative lending, you're looking for the solution that is the best for you to get you back to being bankable in the future and that you don't step on any landmines in the process.
Excellent. So, folks, keep typing your questions, and I'm going to pick these up as we go. So, Ami, let's keep rolling.
Great. How we make financing decisions for our business is complex. There's definitely a part of money, and there's also definitely emotional parts, how we each think about risk and how we manage our business and how we think about our business. So in the first half of the presentation today, I want to give the participants some tools to think about in terms of that and how they think about loans or where we are at. And then the second part, I'm going to specifically get into factoring, purchase order financing, and asset-based lending. So that is the layup that we have for today. I'm going to ask each of you to think about, because today is about growing companies, but at different stages in our business journey, we're each at often different stages. And we know as we build our businesses, it's not a straight line. We'd love to think that trees go to the sky forever and things move sequentially and evenly, but that's not always the case. So sometimes in our business, and might be the case for a lot of the participants today, our business is growing. Things are going well, but growth also brings capital constraints and cash flow challenges. But one of the stages in business is a growth stage, and that's maybe where some people are today. Other people might feel that they're in a plateau. Their business is at a stage, and they'd like to get it to the next level and push it up the hill, but they're a little bit stuck as to where they are and where they're going. So that's what we call the plateau stage. Another is there are business members who are in an inflection stage. Something happened. It could be a change with a supplier or a customer or a change in the market. And there's a bit of a crisis or a change in what's going on in the business that has to be managed. And almost every business has a few inflection points in their life cycle, and that might be where some of you are today. Other people are pretty content. They're milking the cow. Business is going well. They're taking home nice money every year or every month. They're doing great, and they just kind of want to milk the cow or nurture it, and they don't really want to change anything or mess it up. And the fifth stage that we have is the exit stage, which is where people are really wanting to get out the door. They've had a good run or not such a good run, and they want to get done and move on to something else. So my question for you, which will help frame the framework of this presentation is, and we're going to take a minute to do a poll, which stage do you think you're in on your business? Are you growing? Are you plateaued? Are you in an inflection? Are you nurturing? Or are you in an exit stage? So if we could, Dave will help give us directions, but we'd like to have everyone take this poll.
Right, you should have the poll popped up on your screen there. What stage are you in? And just click A, B, C, D, or E. You've got probably about 15 seconds left to do this. We'll close the poll, and then I'll report out on the answers. So, Ami, keep going, and then I'll jump back in when we've got the results.
Right. The reason this is important is that different financing instruments are appropriate for different stages of the company. So, and we'll talk about that further, but if you're planning on exiting your business per se, there's probably not much need to think about growth capital or working capital, or if you're in the nurture stage, some of the loan products we're talking about here might not be necessary for you. So you have to tie the stage of your business to the type of financing products or solutions that you're looking for, and that's why we think this question is important.
And I'll jump in with the answer. So this is not exactly a surprise, given that we've got a Vistage audience here. 68%, so just over two-thirds of companies are in the growth stage, and then 21% in the plateau stage, 5% inflection, 3% each at nurture or exit. So dominated by growth stage.
That's great, and I'm very happy to hear that. And a lot of the products we're going to be talking about today are particularly important for businesses in the growth stage. Now we're going to ask the next question to everybody, which is, what is your personal tolerance for risk? So as CEOs and entrepreneurs at different stages of our businesses and different stages of our life, we each have our own personal tolerance for risk, or how much we're willing to risk for our business. So there's some folks who are risk adverse. They don't want to put up their house, They don't want to personally guarantee anything. They're very worried about taking any personal risk tied to their business. And these are the folks who might, for an analogy of a car, consider driving a Honda Accord. The next folk group of people are risk neutral. They'll with some hesitancy, they'll put up their house or they might sign a personal guarantee, but they're they're still going to be nervous about it. They don't really want to do it. They think they've outgrown that stage. And we might call these folks who are driving the Lexus. And the third group of people are ready to risk it all. They'll do the PG. They're willing to put their life savings up, their houses up, whatever it takes to grow and build their business. And what risk stage you're at is important for the financing products that you think about. So my question for the audience is, do you feel like you're risk averse, you're risk neutral, or you're risk flexible? And we're going to do a poll accordingly.
Yeah, so again, pick one of the three answers in that panel. And let me just jump in with a couple of questions at this point as people are completing the poll. Both Tori and George asked questions that relate to sort of the logistics here, again, big picture. And so what's the typical timeline for getting in place an SBA loan or alternately a non-investment grade loan? And what are the typical terms, like 3-year, 5-year, 20-year? So give us some of the big picture, Ami.
Yeah, so for an SBA loan, which I invite anyone to go listen to the webinar we did a few months ago, which is recorded on the SBA. Those typically take 8 to 12 weeks to get done. And you get terms of 10 to 25 years, and you usually pay a rate of about 6%. They're hands down and often the cheapest financing and the longest amortizing financing available to any members, to business owners, if you can get them. If you can't get the SBA loan, if you want to get a regular bank loan, that might take 6 to 8 weeks. And then the world of alternative financing can take a couple weeks. There's usually a trade-off that you have to be careful about. There'll be people offering you incredible money at very high rates and offering it to you tomorrow. The key about getting money is you don't want to be in a rush. You want to take the time. There are a lot of implications involved in it, and you have to be careful. We've got our results, and 70% are risk neutral, and 18% are risk flexible, and 13% are driving the Accord. And that's about what I expected to get, and it's useful. And we're going to talk about the different types of guarantees involved in many of these lending products and different ways to do it as we go through there. So we have products here that are most likely for the Porsche and the Lexuses, and I have to say that if you're risk averse and you're growing your company, you have to think long and hard about how to do it in a way that you're comfortable with, and you have to make sure that your personal aversion for risk is not affecting the growth of your company in some way. So we're going to talk here about growing companies, inflection point companies, and risk flexible CEOs, because what we're going to focus on today is 3 very different loan products. But the reality is for everyone that traditional bank loans, as we talked about, are tough to get. And so because of this, we've seen the wild, wild west of alternative lending. There are today thousands of lenders out there who would love nothing more than to offer you money, sometimes at interest rates as high as 200%. And you have to be incredibly careful as you navigate this world that you are not, and if you either can't get bank lending or don't want to go through the process of bank lending or don't want to offer the personal guarantees of bank lending, you have to be incredibly careful that you are not stepping onto any landmines out there that could cost you your business. I like to joke that if you go to McDonald's for lunch because you're in a hurry, you might have indigestion for a few hours. But if you go to McDonald's to get a business loan, you could have indigestion for a few years or ruin your business. So you have to be very, very careful. There are some issues to consider in all of these loans. One is I don't have a poll here now, but I often ask the question to my vintage groups when I speak to them, if you are deciding about debt, do people think this is an emotional or a rational decision? Most people raise their hands and say that it's a rational decision. And then I tell the story of a client we had a few years ago who we had an option for an SBA loan at 10 years at 6.5% that involved a lien on his house. And as an alternative for that, he chose a 1-year term with a personal guarantee but no lien on his house at a 36% APR. And people look at their heads and they say, that's ridiculous, that's not rational, and that's the point. For this particular entrepreneur, whatever his gestalt was or whatever his issues were, he was would not put a lien on his house. And so we all have a different emotional component to how we think about debt, and you have to realize this and understand it and think about it as you choose your product. Another question that people struggle with as they think about they need money for their business or growing money for their business is, I call it the Shark Tank myth. There's a great halo feeling there, or a sense that if you just got the right investor or the famous investor to take some equity in your company, everything would be famous and terrific. And the answer to that is, conversely, if you take on an equity investor, you just got married, and you better think long and hard that you and that investor have similar values and similar principles, and you're going to work together well for the long run, which is almost the converse of what our kids get taught on Shark Tank. So typically, we always advise our CEOs and entrepreneurs, when you have a need for capital, think carefully about the pros and cons of equity versus debt, and try to see what both solutions are. The decision about how to get money for your business should give you some angst. You hopefully have two choices to make at least, and you should struggle with them and decide ultimately whichever one is the most comfortable for you, because that's a big decision that has long-term implications to your business and to your life. Some people ask, what is the right price for debt? And of course, we all want the cheapest price for debt. We all would like to get that 4, 5, or 6% loan. The reality is, though, that doesn't work in every situation. If it does, it's great. And if it doesn't, you have to evaluate the options and alternatives. First of all, how much money are you getting? What liens are they putting on your business? How can you get out of it, or what rates, or what are the exit rates to it? So as an example, we had an e-commerce company that had an option to get a $1 million line against their inventory at a rate of 12%, or a $3 million line against the inventory from a more aggressive lender at a rate of 14%. On one hand, you might say, holy smokes, who would ever pay 14% instead of 12%? And then conversely to that, you might say, if that extra $2 million is going to help them substantially grow their business and they have enough margin to afford that 2%, that's the better answer. And also, debt will almost, if businesses work out, even if it's very highly priced debt, will almost invariably be cheaper than the equity component, because remember, equity is for life. So while APR should be understood and is one very important metric, you should not only concentrate on APR as the only factor in your debt.
I want to ask a related question, Ami, if I can, just because
Sure.
Darren typed in a question that's sort of in the same category. He's asking, what is the difference between going sort of to the broader market, regional banks, multinational banks, versus working with your local bank? The feedback he's receiving is that local banks generally can offer better rates than, say, an SBA-backed product. What's your experience, sort of local versus more broadly?
So I think there are two questions there. Our experience typically is, if you're bankable, it's always better to work with a local bank who understands you, who you can shake hands with, and you can build a relationship with. Unfortunately, a lot of those banks are getting bought up in mergers, and local banks are shrinking, and regional banks are getting bigger. But it's always our preference to work with a smaller bank where you can have a personal relationship where the person you're working with is going to go to credit committee and represent you and your interest, and it's not a game of dominoes between different offices in 7 states before you get your decision. So our preference is always to go to the local bank if you can. Conversely, where it gets a little bit more complicated is oftentimes these local banks don't necessarily know about how the SBA and how to take full advantage of the SBA. And so you need to be really sure that you're getting an expert opinion if you are considering SBA about SBAs. So as an example, if you're looking to make a capital investment in your business that requires term debt, typically that local bank, if you're going to ask for term debt without the SBA, will give you 3 or maybe 4 years to pay it back, and the SBA will give you 10 years to pay it back, so it's going to be at a much lower rate. So don't necessarily assume that your local bank is the SBA expert, because often they aren't, and you want to make sure, again, that you're going to get a couple of really good opinions to figure out the best possible way to structure your debt. Does that make sense?
Yeah, excellent. Thank you.
Okay. I want to generally explain 3 types of guarantees. There are full personal guarantees, where the CEO or any shareholder who owns 20% or more of the company is expected to sign personally for the loan, and that's the reality in many situations. For SBA debt, for almost all the 7A loans, if you have a house, they're going to put a lien on it, a second lien, and that's part of life, and liens in houses is part of life for many CEOs. And there's a third program, which is more in the world of some alternative lenders called surety guarantees, where the CEO or the entrepreneur will guarantee against fraud, or guarantee that in the case of liquidation, they will be around to stick around and make sure the lender is able to get out as much as they can, but they don't have to do a personal guarantee. Now, many banks are not into the surety guarantees, but if you get into some of these alternative lending products, sometimes you can get one. And so those are some of the things to consider as reference to guarantees. Another big issue that we see CEOs making a mistake, or entrepreneurs as they think about their debt, is they're thinking with too long of a horizon. So I met once, we had a client a couple years ago who was starting, of all things, a horse shampoo factory. She had invented what she thought was the best horse shampoo in the world, and she had been suckered, and someone had taken her last $40,000 to write a beautiful business plan that involved a raise of $5 million to buy her factory and build it and the equipment that she needed, and she didn't have a penny to her name. The mistake she was making is she was planning on way too long a horizon. You should always think about your financing in 12 to 18 months, and if you're not bankable today and you have to pay a little bit more, you don't assume that that's forever. You need to make sure you sign a contract that gives you the flexibility to get out of it and move to bank financing over time. But think about financing in baby stages or evolutionary steps. It's almost like growing a child. You can't teach your child calculus before they know to count, 5 plus 7. Sometimes your business will need a non-bankable product, and that's okay as long as you understand that it's not forever and that you make yourself a plan to get out of it. Another big issue is the debt that you're getting for your business the right fit? I don't know how many folks in the room have a line of credit, but line of credits are designed for working capital hiccups or issues as you have cash flow issues, and should not be used for long-term investments, such as a substantial investment in infrastructure or equipment or anything like that. Term debt should be used for longer-term investments, and revolving credit or lines of credit should be used for cash flow hiccups as they come up. And you have to be particularly careful that you are using the right product at the right time. I would advise everybody on the phone to avoid what I call the short-term debt treadmill that is plaguing a lot of businesses out in this country today. if you go online and you put in, you're looking for a business loan, or sometimes you'll even see these ads all over television, they can get you up to $500,000 in 24 hours or 48 hours, and they will solve all your problems. The problem with many of these loans is that they amortize very quickly. They debit the money out of your checking account every day, and they have all the indications of a debt trap, very similar to payday lending that could capture businesses and get you in a lot of trouble. So these short-term online lenders are typically very dangerous for businesses. We wish to avoid them at all costs, and we encourage businesses whenever they can, and we're going to talk about other solutions that can work, but to avoid these short-term online loans if possible. Always get the longest amortization possible and the lowest monthly payment possible, and then pay it off faster, but give yourself the flexibility so you'll be able to work through lean times or hard times. And today, and I'll just take a question, Dave, if there are any questions now before we move to the next stage of the presentation, where we're going to specifically talking about factoring, asset-based lending facilities, and purchase order financing. Are there any questions now, or should we move on?
No, let's keep moving on. There are some questions, but I want to loop back on them. The specific ones that have been posted towards the end, I think they're most appropriate then. Actually, since Christoph is typing a question now that I think is directly relevant, if alternative lenders are dangerous, how come they're growing so fast? So why is that a viable business?
Well, first of all, I want to say that I don't think all alternative lenders are dangerous. I think particular loan products of many specific types of alternative lenders are dangerous, which is why I mentioned that you want to avoid the landmines wherever possible. So loans where typically what many of these alternative lenders will do is they'll tell you that they'll lend you $50,000 and you'll pay them back $60,000. And so the borrower will think that's only going to cost them $10,000 or 20% interest. The borrower won't focus on the fact that that amortizes over 6 months instead of 12 months. So then you could say the interest rate is closer to 40%. The borrower also won't focus that instead of making a monthly payment, which is typical in a loan, the money will be debited out of their checking account every single day, which creates an interest rate on an APR basis close to 80%. That cash flow pressure almost invariably causes the borrower to have to renew the loan multiple times, and they get stuck in a debt cycle that's very difficult to get off of. That's the type of alternative lending you want to avoid if at all possible, or you only want to use it in very specific situations where you have a clear plan to pay it off.
Okay, great. Thanks for clarifying.
Okay. So now we're going to talk about factoring. So again, it might have been helpful to have a poll up where we ask people how many folks are in the B2B business or they have accounts receivable or inventory or assets like that with other people. But factoring is specifically for the situation of businesses that sell products to other businesses. And cash flow challenges are created by the fact that you're waiting for your money. So the general idea of factoring is I sold you a product. Now I'm going to wait for 30 days to get paid for the product. And so you can get an advance on that money, get some of that money in your checking account today and avoid the cash flow pain. Typically speaking, depending on your industry and the customer's credit, you can get 80 to 95% today. So if I sold you a product, if I sold a product to Walmart today for $1,000 and Walmart was going to take me 30 days to pay me, the factor would advance me anywhere from $800 to $950 of that money today, so I can get it. What happens is that the factor sets up a lockbox, and so when Walmart pays them, they're going to still write a check to me, but go directly to a lockbox controlled by the lender, at which point the lender will, who's already advanced me the 80 to 95%, will deduct their fees and pay me the rest. B2B companies of all sizes and industries are using factoring, and factoring is great for startups and high-growth companies. Sometimes business owners or clients feel that factoring is an embarrassment or they're nervous to do it. And the truth of the matter is that there are hundreds of thousands of emerging or fast-growing companies who are using factoring today. So how does it work? The customer orders a product for $1,000. You deliver the product. The money, you will then get the money minus a reserve in your account. When the customer gets paid, you will get the difference minus the fees. So it is quite a fairly simple process to advance you the money. So as you sell, and if particularly in a high-growing business, you can get your money as you go. The advantages: this will boost your cash flow. Sometimes the factor will help you with the collections process. The factor will help you assess. Many businesses are essentially extending credit to other businesses without knowing the economic viability of those other businesses or if they're good credit risks. And the factoring will take that because the factor will assess each client's risk and decide if they're willing to advance to them. And if the factor is not willing to advance to a client, that creates good reason, and maybe you shouldn't do it also. One of the other advantages of factoring is the factor is not going to be concerned about your business's credit, profitability, or viability. They're going to be concerned about your customers' credit, profitability, and viability. They're worried about your customers because they are essentially buying that invoice for you, and they're not worried about you. So if you haven't turned a profit yet, and you're not bankable, or you aren't able to secure a loan, maybe because of dings in your personal credit, and you have invoices to set invoices, factoring could be a good way to borrow. You also cannot, one of the advantages of factoring versus, say, the short-term online loans I was talking about, is you cannot borrow more money than you've sold. And so it creates some kind of security in that mechanism. Some people say, how much should you factor? You shouldn't factor more than you need, because the factoring is going to cost you money. It's going to cost you a percentage of every invoice that you use. So you should selectively factor as you need to grow your business. There are two kinds of factoring: recourse and non-recourse. Non-recourse factoring says that it puts all the risk of that collections of that receivable on the factor, and recourse, you as the customer will ultimately be responsible for it. Some factoring companies offer both recourse and non-recourse factoring. Typically, if it's non-recourse factoring, it's going to be a bit more expensive. And so you have to look at this, and when you're thinking about factoring, decide if you want a recourse or a non-recourse option, and decide whichever one is the most comfortable for you. You have to be particularly careful in factoring to try not to sign a long-term commitment. Oftentimes, factors will try to have you sign a long-term contract with very expensive exit clauses if you try to get out of it. You don't want to do this. Ideally, you want to sign a 6-month factoring contract, maybe at the most a year. You want to be very careful not to sign a long-term commitment, and you have to be very careful to understand if there are automatic renewals in the contract, when they are, and when to get out of them, and keep a clear view on those. Again, you want to ultimately get to the bank or get to a straight line of credit with your bank. It'll be dramatically cheaper than the factor, but these are some of the things to think about. You have to watch out on the term sheet for all kinds of hidden costs, money transfer, shipping, other costs of doing business. You have to be very careful that you're getting the cleanest and the simplest factoring contract possible. There are some terms that I think are important for any member or listener to know about when it comes to factoring. What is the discount rate or the fee that the factoring will chase? So a factoring company might say to you, they'll charge you 5% for an invoice due in 45 days. Well, what if that invoice gets paid in a week? They're going to charge you the 5% anyway. Typically, the best possible scenario, if you can negotiate it, is to get a very simple daily factor rate. So if the invoice is paid for 2 weeks, in 2 weeks, you will pay the factor for holding the money for 2 weeks. If the invoice is paid in a month, you do it in a month. Be very careful because these terms can be very tricky. Sometimes there'll be a rate for 30 days and then an additional rate for extra 10 days after that. Sometimes there'll be a rate for 60 days. You have to be very careful, and you have to make sure that you're getting the lowest possible rate possible. And oftentimes, because you don't really know when the customer is going to pay, if you can negotiate or organize a daily rate, that will be the best for you. It's also important to negotiate or think about or get some opinions or quotes on the advance rate. It's a big difference if a factor is going to advance you 80% on your invoices or 95% of your invoices. So you have to pay careful attention to this. It might not feel relevant now, but since you're going to have this contract likely for at least 6 months, if not a year, you want to negotiate the highest advance rate possible so that you have the flexibility to get out of it in the future, get as much out of it as you need to in the future.
Ami, I want to jump in with a couple of questions right now that are, again, exactly on the topic. So William's asking, what are some reputable factoring companies or maybe some of the names that might be the leaders in that space? So let's take that one first.
It's a tough question to answer because there are hundreds of them, and a lot of it depends on how big your business is and what industry you're on. So there are factoring companies that are better, say, in the staffing industry than in the trucking industry. There are sometimes factoring companies that are better in certain regions of the country. So I'm loath to answer that specifically because sometimes factoring companies, it also depends on the quantity of or the dollar volume that you have to factor. So I don't mean to punt on a question, but it really depends on the specific situation.
Well, let me ask then just a follow-on. How would you go about vetting a possible factoring company? What would you be looking at to decide whether I had made the right selection?
Well, you want to get a couple quotes. You want to make sure you have an expert who's advising you and helping you make sure you understand all the nuances and the prices and of different options, and you don't want to do it in a rush. Okay. I've seen some factoring quotes. Oftentimes we'll see a factoring contract in our office that a client has taken on before they work with us, and I shake my head because I know that they can get factoring at 50 to 75% lower than they're doing, which also speaks to the point where it's very important, in our opinion, to regularly review your debt. So I don't know if there's anyone in there today who is factoring today, but you may or may not need to do it anymore, or there might be a cheaper alternative for you depending on where your business is. I mean, we've seen some AR financing deals as low as an all-in rate of 8%, as high as 100, 150% if you factor in the whole rate. So it really does depend.
Since you brought up the topic, I want to back all the way up to a question that Bob asked early on. And I know this is about educating, not selling your services, but just since you are in this space, can you talk a little bit about how you work with companies that want to review or rewrite loans at lower rates?
Sure. So we're happy to speak with any businesses, and we'll review the situation. If we feel we can help you, we'll tell you how and what types of loans or what rates, how we can help you structure your debt. And then we don't have any upfront fees or retainers or exclusives. And 95% of the time we get paid by the lender, so there's really no cost to work with us. And oftentimes that second opinion can be extremely useful and valuable to one of our clients.
Okay, excellent. Great answer. And then one last question, and we'll keep going with the presentation. But Andrew is asking at this point for a seasonal business that has highs and lows in revenues. Any particular favorite debt products that you would point to for such businesses?
Yeah, again, so we're going to talk in a minute about ABL lines. But one of the deficits of factoring is that you can only advance based on the invoices you've sold. So if the business doesn't have any inventory, they might consider some term debt to go side by side with factoring to help them through slow months. And if there's inventory involved or purchase orders involved for seasonality, which often is the case, then we move to ABL facilities or purchase order facilities, which we're going to discuss next.
Okay, great.
Okay. Again, I would advise anybody, if you're doing a factoring contract, to try to avoid a long-term contract. Keep it short as possible. Things could change. You don't want to have expensive prepayment penalties if you're going to get out. And try avoid guaranteeing monthly minimums to the factoring company, because they're going to hit you with all kinds of charges if you don't hit the minimums, and that is the last thing that you want. Occasionally, there are companies that will allow you to do spot factoring, which means you can do it occasionally in urgent situations. That's a viable option, and sometimes it's going to be a little bit more expensive than doing regular factoring, but it's another option if there's a short-term cash crunch that businesses should think about. Another big issue is that many businesses have with factoring is 95% of the time factors want a notification process, which means they are going to notify your customers that there's a new lockbox to pay and that you can expect and that you have entered into a financing agreement with them. Many times customers balk at factoring because they do not want to go through the notification process. The reality is, though, that most of the time this paper goes straight to someone in the accounts payable department. They're very used to it, and we've never seen it become a problem. If you want a non-notification product, there are some lenders out there that do them, but usually you're going to pay a bit of a premium for a non-notification product. If anyone doesn't have any other questions in factoring, we're going to move on to asset-based lending products.
Perfect.
The big difference between an ABL and a factor, and again, this may be relevant to the seasonal business, is that an ABL will lend you money not just on your AR, but also on your inventory and sometimes on your equipment. So as an example, if you were to do factoring, the only thing you can advance against is your current invoices. But let's say there's a business with $1 million of AR and $500,000 worth of inventory. In the case of an ABL facility, you're able to get an advance on your inventory as well as your AR, or sometimes if it's just inventory, just against your inventory and or your equipment. So typically, once you've moved up to an ABL facility from factoring, you're going to pay less money, and you're going to have more flexibility of creating a higher borrowing base.
What kind of terms are we talking in terms of length on these ABL facilities?
Typically speaking, the ABL facilities, again, you can sign a contract for typically a minimum of a year. They're different from a factoring arrangement. In a factoring agreement, you're buying and selling individual invoices. In the ABL facility, they are advancing you a percent of all your AR, and they are advancing your percentage of your inventory and your equipment, if that's applicable. And you pay a monthly interest fee against that. So it's essentially like a ledgered line of credit that is levered against the assets in your business.
And so minimum of a year, what might be on the maximum side, just to understand the range?
You shouldn't sign any of these contracts for longer than 2 years.
ABL 1 to 2 years. Okay.
Correct. So again, if you're growing quickly and you have more assets, so sometimes companies will step up from factoring to an ABL facility, and this can be incredibly useful to you because you are levering more of your assets. So especially if you are an inventory-based and an AR-based company, or more inventory than AR, depending on the lender, you can get different situations. The other nice thing about the ABL lenders is they're going to want to see a path to profitability, but they can be a part of a turnaround plan. They don't require the profitability and the cash flow in many instances that banks will, but they will lend against the assets without necessarily having to see immediate cash flow or profitability. If it's part of a growth plan or a turnaround plan, the asset-based lenders will do it. Again, they're going to use the inventory, the equipment, but primarily they're interested in the accounts receivable. Borrowing base is determined as a percentage of your AR, a percentage of your inventory, and if you're going to use your equipment, typically as a percentage of the forced liquidation value of your equipment. What it is not, that this builds the formula for how you do it. Typically, every 2 weeks, sometimes 2 weeks, sometimes 1 week, you submit reports to your lender of how your business is doing and financial reports, and that affects your availability. So you might have $1 million of AR when you sign on with an asset-based lender and $1.5 million in 3 months. And if you have proven evidence of that, which they will advance you the 85% of the $1.5 million in 3 months, whereas when you start, they'll advance you the 85% on the $1 million. ABL facilities typically require a site visit, and if there's inventory, an audit, and if there's equipment, an equipment audience. So they are a little bit more cumbersome and time-consuming to get done than simply a factoring agreement, but the rates are going to be lower. Generally speaking, you're going to see all-in price on an ABL ranging from 7 to 17%, which is very different than the factoring, which can be much higher than that. So sometimes the pain is worth it to get through an ABL facility. Are there any questions on the ABLs?
I think we're good so far, but folks, post your question in the Q&A panel if you've got one.
Okay. Meanwhile, we'll keep moving. Essentially the difference fundamentally, the asset-based lenders are going to let you collect your money. They're not going to be involved in the collections process as factors are, and they're going to lend you money more broadly against more assets.
Actually, one quick clarification, Ami, from William. Just what was the range of the APR on the factoring side in comparison to the ABL side?
Typically, when you calculate a factoring, we've seen it anywhere from low to mid-teens in as high as on an APR basis, 100 to 150%. ABL facilities run typically from 7 to 18%, depending on the situation.
Okay.
Factoring ABL facilities will be cheaper for you in the long run if you're eligible for them and you have the assets to back it up. Now we're going to move into the world of PO financing. And fundamentally, purchase order financing is when you have a purchase order to produce product for a customer and you don't have the money to pay your supplier. So let's take an example. You have a customer, say Walmart is your customer. Walmart has ordered 1 million widgets. Your factory in China supplies the 1 million widgets, but you don't have the money to back it up. The PO financer will post a letter of credit to that factory in China for the 1 million widgets, so they know whatever happens, they will get paid, and you then are able to get the products produced, shipped, and moved on. PO financing is expensive, but sometimes if you have the margins to support it, it's not sometimes, it will always be cheaper than equity. I loathe when people are on Shark Tank and they give away equity in their companies and they need the money for working capital requirements, and they could have in fact used it for purchase order financing. So the supplier gets a letter of credit issued against them. The money is advanced. You're able to get the product fulfilled. The supplier, the PO financer will pay the supplier. The PO financer, then you typically, hopefully you work with the same trade finance house who also does the AR. They will hold the AR financing and you get the money flowing. If you have the margins for it and you have the right PO financing instrument in place, you can focus on selling and not worrying about, shutting down yourself or not being able to make payroll because you don't have the money to support it. PO financing works in a way where one of the other factors that's important about PO financing is for it to work, you have to order directly a completed product from your supplier. If you are, in fact, manufacturing the product yourself, there are lenders who will do it, but that is more called production finance, where they will help you cover your raw material costs and your labor costs, et cetera. But PO financing, traditionally in its traditional sense, is really for a wholesale, almost a distribution company who is buying their product from one place. They almost never touch the product. It leaves the factory and goes straight to your customer. One of the things we will always advise on the PO side, if you can, because a PO lender wants to have an accounts receivable lender in place at the same time. So if you are doing PO finance, set it up in a way that you do the PO and the AR at the same time. And the other thing we advise, if you use the same trade finance house that does PO financing and AR financing, hopefully over time, while you might rely on the PO financing at the beginning, as your AR builds, you can use more of the AR financing and use PO less. You want to always use AR financing before PO financing if possible, because typically the AR financing will be at about half the cost of the PO financing.
By the way, George is asking a quick question. Is a personal guarantee required for all of these various modes, factoring, ABL, and PO financing, or is there some difference?
Typically, there is many times there is a personal guarantee, but sometimes, depending on the ownership structure, it can be arranged with a surety guarantee.
Okay.
I'm not going to ask a poll question of which financing product seems best for folks based on the discussion. Do people feel that in their particular situation, factoring is most appropriate for them, ABL facilities are most appropriate for them, PO financing is most appropriate for them, or perhaps we should have had a fourth one, which was other. We'll stick with the three for now.
Yeah, so folks, put your answer there in the survey, and Ami, keep going, and I'll jump in when we get the votes tabulated.
And so what I've tried to do here is to lay out the world again of alternative lending products that I think are best suited for businesses who are in high growth situations who cannot get bank loans. If you are bankable and you can get a line of credit from your bank, or you are able to get an SBA loan, I would always recommend those in front of any of these solutions because it's going to be cheaper for your business and probably better for you in the long run. But if you are in a high growth situation, which is the case, I believe, of many of the people in this survey, often these alternatives are viable and strong and useful to help push your business to its next stage. And I also just want to invite, we have a few minutes left. I know the poll is wrapping up, but if anyone has any questions or specific questions that you feel we have not covered today, we'd be happy to discuss them as well.
Yeah, so folks, type your questions in there and I'll pick them up. We should have the poll answers here in the next few seconds. So, Ami, I'll jump in as soon as they put. In fact, there they are. So it looks like the majority of folks that answered, since we didn't provide another option, it was the asset-based lending, ABL. 57% answered that. 29% thought factoring might be the right thing, and then 14% PO financing.
Great. Terrific. Okay, well, we have a few minutes left, folks. I really appreciate everyone's time today and filling in these surveys and helping us hopefully make this as interactive as possible. And I sure would love to take any questions from the audience as possible.
Yeah, so we have just about a minute or two left for questions. George has posted one, what type of lender makes PO loans, et cetera?
Typically, there are lenders, again, who specialize in PO loans.
Okay. And what's the timeline on each of these three? So factoring, ABL versus PO financing, how long does it typically take to put one of these in place?
So typically the factoring will be the fastest, and followed by the ABL, which will take longer. ABL, because usually there's an audit involved, will take a couple of weeks, 4 to 6 weeks. And the PO financing, although everything can be rushed, will typically take 4 to 6 weeks as well.
Okay. Bob asks, will banks loan money using PO and AR funding strategies for startups if the startup has signed purchase orders?
Typically not. So typically banks don't want to, unless you have a particularly strong relationship with your bank, or the bank has some kind of relationship with you, or you have some other collateral in the bank, typically speaking, that's not going to happen.
Okay. Christoph asks, is there a size business or maybe age business which you need to be in order to access these kinds of loans?
Typically speaking, these businesses, you can factor as little as a few $1,000s, and you can be in business for a day. As you get to ABL or purchase order financing, typically they don't really care about age, but they're going to be interested in size and growth.
Okay. Roger asks, if all assets are pledged to a bank, is it possible to do an asset-based loan?
Asset-based loans will require a first lien on AR and inventory. And so if there is already a relationship with the bank, you either have to negotiate to take the bank out and have the ABL replace it, or negotiate an intercreditor agreement with your bank.
Okay. Mike is asking, how long should a business expect to be in business, or what would it expect to or need to achieve before personal guarantees are not required?
Usually a few years of strong profitability and a very solid balance sheet before personal guarantees are not required.
All right. And then the last question is from Andrew. In your view, is the Fed doing a good job? Do you have any opinion on the general market conditions right now?
I don't like the fact that so many small businesses are forced to borrow money at such egregious usurious rates through these short-term online loans. So my opinion is that the Fed and the system is not doing a job, because hundreds of thousands of businesses are getting stuck in loans that they really have no way to pay back. That's not what we're talking about today, but that is a lot of what we see happening in the market.
All right. Well, we're at the end of our time, and there are a few more questions. So for people who can see the screen, please grab Ami's contact info, but I'm going to read it for people who are maybe listening to the recording after the fact without or aren't looking at the screen. So Ami Kassar can be reached at email, akassar@multifunding.com, and you can reach him at 215-460-1950, or check out the website, www.multifunding.com. So please, if you didn't get your question answered today, reach out to Ami. But Ami, thanks a lot for a great session and being so interactive and responsive to the questions that were coming in.
Thank you, and I really appreciate everyone's time, and wish everyone only the best of luck with their businesses.
All right. So, folks, join us again. Next webinar is going to be in a couple of weeks, Friday, August 12th. Deborah Fell is going to talk about strategic plans gone bad, 5 ways to fix your focus. As always, you can register at vistage.com/FWV, as in Fridays with Vistage. And that's a public part of our My Vistage site, so you can invite guests or outside associates. You can also access past recordings and slides at vistage.com/webinars. This one will be posted by about the middle of next week. So on behalf of Ami Kassar and the entire team at Vistage International, I'm Dave Nelson. Thank you for joining us today. Have a great weekend.